Hit it.
It's Friday, May 28th, 2021, episode 133. I'm Patrick Ceresna.
And I'm Kevin Muir. This week, we welcome back to the show fan favorite Jim Leitner. We have a fascinating discussion about how retail can make their very own digital options, why Jim likes uranium stocks, and then we have a Huddle First, our very own social science experiment that you won't want to miss. After that, in Talking Charts, Patrick explains why he can't practice his craft on a full moon. Who knew?
This week in trading history, we go and look back at the Solomon Brothers cornering the bond auction, and then we end with our segments of No Stupid Questions and Skin in the Game, and we might even drink some beers along the way, so stick around. We've got a great show. Lena, hop on. What beer are we drinking this week?
This week we are drinking good old Milwaukee.
We're going on a little tour of American beers.
I don't even have a blurb from them, to be honest. Like, need I say more? It's old Milwaukee.
We went from IPAs to these like exotic sours, and now we go from PBR to old Milwaukee.
Some people asked if they could drink beers with us, and obviously it's going to be difficult when we're drinking kind of Ontario craft brews. But I was thinking that maybe
we can definitely share this one.
Yeah, in the coming months, we will organize a tour of the world, and we will do a beer from every country.
That's a great
And then
idea.
maybe we could announce it in advance, and then people could try to figure it out.
You know what? That's a great idea. Like we'll pick one beer from every country,
and we'll try to get her done.
I like it.
Okay, so before we do our side effects, Lena, why don't you give us a little update on the Huddle Muddle?
So the Huddle Muddle in Miami registration is now closed. So we're
we're already full?
We're
capacity.
full. My God.
Well, that's it. Then we don't have much else to say. Let me do my side effects.
There will be some interesting guests there.
Interesting guests. Okay.
I love it. And some surprise guests, maybe. We'll see. All right.
Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in this show. Side effects of too much huddle may include Van Damming your Vega, inappropriate Lacey Hunt posters, something Patrick knows very much about, and the sour slurs.
Oh, wow.
That was a good one.
That was really good. All right, we have the great pleasure to have Jim Leitner from Falcon Management back on the show. Welcome back, Jim.
Hey, happy to be here.
It's great. It's Kev here. Jim, I've been looking forward to this a long time. When you were on, you were one of the guest favorites, and they had all sorts of questions and all sorts of things that they wanted to still pick your brain on. So let's just jump right into it. Let's start with one of the things that you talked about last time you were here. You talked about digital options, and digital options are generally offered to, sophisticated investors with the ISDAs, but you have a way around that. You have a way that you could do it for the retail trader. You want to share that with us?
Sure. Let's say that you have the view that over the next year, the S&P is going to go up 14%. Nothing huge, average. So that would put it around 48 and a little bit higher, right? A digital option basically is the probability that you will be above that. So how can you recreate that? Well, what if you bought a 47.75 and sold a 4800 strike, right? So you had a very tight call spread just around where you believe the market would be or higher, right? So if you are right and the S&P ends up at 4,800 or higher, you will make those 25 ticks because you buy the 47.75 and you sell the 4,800. And that market is absolutely liquid. You can do that as a retail investor with no problem. So I was just looking at the close where that was trading. And of course, on the close, it's a little bit wider. But it was offered at about $6, so you could pay $6 to make 25, right? Which gives you about a 24% probability. Yeah. And it was bid at about 3, so that's about 12%.
Okay.
Now, that market moves around during the day quite a bit because there are different market makers on the bids and offers and the screens. I use something called TradeStation, but lots of people have other platforms. They all have something called vertical option spreads.
Right. Okay.
So when you look at the vertical option spreads, they'll show you the prices, the best prices, bid and offer between two strikes. And then you can search for the two strikes that represent your belief in the future.
Right.
So let's say you believe it's a 50% chance that we go to 4,800 because whatever, the Biden administration is going to do whatever they can to get reelected. They're going to spend a lot of money. You don't foresee any terrible inflationary problems. And then you see that that's offered at 24% of probability.
Right.
Because, the difference between 4,775 and 4,800 can be bought for 24% of whatever you want to make.
Right.
That seems like a reasonable trade.
Right. So you can do it's the digital options for the retail investor.
Exactly. You go and you look at the vertical option spreads. You can do it on individual names. I've done it on things like TSM, which is the ADR for TSMC, the Taiwan semi-manufacturing company. I've done it for ASML, which is a company that makes semi-manufacturing machines in the Netherlands. I've done it for the Brazilian stock market index. I mean, I like to think in terms of ending probability often. Right. It just helps me think about the probability distribution where, if something appeals to me, it's normally because I have a feeling it's more than a 50% chance it's going to happen. Right. So I'm reading about whatever it may be, semiconductor manufacturing makes me think that, people are going to need those machines. I look at where the prices of the stock and I think, well, what would happen if a lot of people bought that machine? Where could that stock go? I do some analysis. And when I start feeling that, it has significant upside, I'll look at that digital probability of the market's actual pricing of what I believe is maybe closer to 50-50.
Right.
And it's on a forward base, always cheaper.
The one thing as well that a lot of people might not realize is that when you buy an option, let's just say you were to buy only the long portion of your leg there, all the probabilities of, it going way higher than that are priced into that option. So you're in essence paying for those possibilities, and you're saying, I don't want that. I don't care if it goes to 5, like back to the S&P, if it goes to 6,000, I don't want that. I just want to, bet from this point to this point. And so it therefore ends up being a lot cheaper as well, because you're not paying for extra possibilities that you're not really interested in.
Correct. Unless you have a strong view that the tail, as they call that long strip, is larger or wider than what people expect in the market, why pay for that extra possibility that something great might happen if you don't have that view, if you haven't spent time analyzing that view? So I think this idea of using these very tight spreads, you could do put spreads or call spreads, just depending on what you believe in and what you are looking at, just helps you identify the bet more precisely.
Yeah, that's a great way of putting it. The other thing I just want to point out for those that are trying to do this for the first time, you can actually create that call spread, that put spread or whatever, often in your trading software. And when it's executed, it goes down to the exchange as an actual spread that market makers will trade against you. So therefore, you don't have to go and pay up for one and then sell the other. You don't need to do them as two transactions. You can definitely create them, execute them as one. I know I have this WEX software that I can actually see all of the orders that are getting sent as spreads from the different exchanges, and they're floating by me. And there's market makers that are watching those and will trade against you, because it's actually easier for them, because to some extent they're just trying to hedge a very tiny little portion out of that. Like they might do it for 2 vol points even though it's 4 vol points wide, right? So they'll be in between. So that's a great kind of reminder for those that were upset that you were trading all these digital options and you weren't allowed to do it. So one of the other things, Jim, that when we kind of think about your way of looking at the world, you definitely are one to believe that you should go and look at history. And you always say there's lots to be learned from history and there's lots to be looking back. Why don't you kind of flesh that out a little more for us?
Sure. So last time we talked about listening to the game master, which is really about the present. Right? It's not about history. It's trying to understand what the government today wants to achieve or what a policymaker is trying to do. But really, we live in a world where we have historical knowledge. So let's assume you and I played a game where, sit in front of a computer screen and you see little red dots and green dots flash up.
Okay.
And I say to you, look, if you forecast the next dot, I'll give you $1. And you kind of watch that screen and you've seen about 100 of them go by and you have a sense that, well, there are a lot more greens than reds, but, you hadn't forgotten to count, but I was counting and I tell you, yeah, you're right. There are more greens than reds. There are about 70% greens and 30% reds, and you've seen 100 go by now. And I said, well, what are you going to do? What's your next call?
Right.
So what would you do? What do you think you would do?
Well, so I unfortunately I've been afflicted with a lot of love of reading about probabilities and risk and things like that. So I know what I would do. I would end up probably not what everyone else would be doing, because I would end up doing something that was a little unusual. And it's kind of like, to me, it's like when someone goes to Atlantic City and sits there and wants to play blackjack. And I'm one just to play purely by the book. I play it, the odds, or whatever it is, the odds are, I know that that's my edge and that's how I should do it. So I would take advantage of that.
Right. So when one has played this game in laboratory settings with people, they end up what's called probability matching. So probability matching means the tendency of making your own choice vary with the probability of the underlying occurring. So if, let's say, you have 70% green dots coming by and 30% red dots, on average, like as people are forecasting the next dot for the next 100, they're going to forecast 70 greens and 30 reds.
So I find that fascinating. So they've actually done this in studies, and they've gone and done it. And so when they look at large groups, on the whole, people seem to match the probability. It's almost like they think they can predict which of those, that they're going to be. They're almost going for 100%.
Exactly.
Yeah.
And there have been hundreds of studies done, and it happens all across the animal kingdom too. So
Oh,
it's
really?
done with honeybees, it's done with cows, and there is an evolutionary bias why this is true, because when you are trying to protect the whole group,
Okay.
let's say you have bees foraging for honey or nectar, right? And there are fields of flowers. They don't all go to the same field where there's the most honey. They spread across in the same percentages as there is honey in the different fields. So if there's a field with 70% honey, about 70% of bees end up going there, and about 30% end up going to the other field where there's only 30% of the honey.
Right. Okay.
Because they're not all going to go to one field. It wouldn't work very well in terms of allowing the whole group to maximize. So,
right.
But when we're playing this game, right, if we actually did what we are evolutionarily inclined to do, which is do this probability matching, we would be only correct 58% of the time, right? Because we'd guess green 70% of the time, and we'd be correct 70%. So we'd be right 49% on greens.
Yeah.
And on reds, we'd guess 30%, and we'd be right 30% of the time. So we'd get 9% on the greens. So altogether, we get 49 plus 9. We get 58% right.
Right. Okay.
If we always bet green, we'd get 70% right.
It's shocking, isn't it?
So if we just didn't care about the reds and just said, look, I'm just going to bet green all the time, we would outperform. And you know why I do that and why I talk about that a lot is that I think we often tend to do this in our investing life. So let's look at this example that I was giving you, 70-30, is really the annual performance of the S&P going back to 1900.
Okay.
It's about 69% up years and 31% down years.
Right.
Right? So when I look at that baseline, I think to learn from history, you really need to look at the baselines.
Okay.
Now, you and I might disagree on how you calculate the beginning of the baseline. You might say, like what happened from 1900 to 1950 is really just not that relevant anymore.
Okay.
Things have changed. The world has changed. The central banks have decided that stock markets matter, and I'm going to look at the last 30 years.
Okay.
And also, let's say, for example, instead of just looking at it annually, you look at it every day over the last 30 years. So on January 1st, you buy it and you hold it to January 1st the next year. On January 2nd, you buy it. So now you have 30 times 220 business days. So you have about 6,000 to 7,000 observations.
Right.
Right?
Okay.
Now, why do I say 30 years? Well, 30 years puts us back to like 1991. I think that's kind of when central banks really started waking up to the stock market being a force. That's when we get in 1997 irrational exuberance. We get this talk about the central banks are watching what's going on. They're starting to care.
Okay.
And what do you think the probabilities are in the last 30 years? What's the baseline?
I don't know. I'm going to guess that you've recreated it with the bees and the.
I'll tell you what it is, so you don't have to embarrass yourself. It's 80% up.
Oh, it's 80. 80-20.
It improved from 69-31 if you go back to 1900 to 79.84%. So let's call it 80%.
Right.
80% up years and 20% down years, where each day starts a new year.
It's a slice. Okay, I got it.
So you have a lot of different observations. So when I look at that, I walk in and I always want to buy 1 year options because there's an 80% chance looking at the last 30 years that I am going to be correct on that. Now, if I don't do that, that's okay. I might just feel nervous about the world, but I need to have a view why I don't want to do it.
Right.
I've got to come out with, the CAPE is too high. The CAPE, the cyclically adjusted PE ratio, blah, blah, blah. Okay, so I can say that when the CAPE is over 35, historically we've had negative 1 year returns.
Okay.
Okay, that's a true statement, but let's look at the actual data. My next step would be, let me look at the data. And the data is, we had 3 occurrences, and on 2 of them, the stock market was down, and on 1 of them, the stock market was up. I don't feel it gives me a lot of reason not to be in the 80-20 bet.
Okay.
And this is kind of what I did over the last 2 years. I was consistently buying 1 year or 18-month S&P digital calls. And people would say, that seems a little extreme or out of the money, but statistically, it's the right bet to take unless you decide that you don't want to be long the stock market, which is totally fine. You might have your own reasons, and you should think about why you want to be long. But having the baseline right in front of you helps.
See, when you explained it, with the kind of the red and green dots, it became very clear to me that I should be always betting green. Like, it's just very, very clear. Then when you switched it into the stock market, it was like, but there's all these reasons. And I'm like thinking, but no, Jim's absolutely correct. That it's the same argument applies to the dots that applies to the stock market. And yet me, even though I know all this, I have trouble doing that. So I actually thank you, because I'm now going to think about things a lot differently in terms of the, like, instead of acting like the bees, I'm going to act like Jim Leitner, putting everything into probabilities.
Well, I think it helps. I don't do this trade every day. I step back, I kind of think about how big a position do I want. But in general, I find it much safer to do upside bets because every once in a while you do get these big downturns, and at least I know how much options premium I'm going to lose.
Right.
It makes me feel like I can sleep. I can be relaxed about it. So that was one thing to look at history. Another way to look at history really comes with this investment clock approach.
Okay.
Which I think a lot of people have heard about and looked at. There's some service called Hedgeye that popularizes it today. But really, the first time I saw it was done by Trevor Greetham from Merrill Lynch when he was strategist at Merrill Lynch in 2005. And he sent out an investment clock report on the four quadrants where you had growth and inflation changes, like 1 year over 1 year changes. Was inflation going up? Was growth going up?
Okay.
Was growth going down? And then, of course, you would hypothetically think about, well, if that happened, what would you want to own? And that's how you decide. You look at the quadrant and you say, oh, okay, right now we have inflation and growth going up. What would I want to own? Well, something that goes up with inflation, like commodity-linked type of equities and commodities themselves. What do I want to own when growth is going down and inflation is going down? Bonds, right? I mean, they go up in that world. And if growth starts going up and inflation is still low and going down, well, then I want to own long duration equities. Right. And the only problem you have is when, inflation's going up a lot and growth is starting to come down, and they call that quadrant stagflation.
Right. Okay.
And that's the one where in history, cash has done better than anything else.
Right.
So I tend to look at this investment clock just to get a sense of it. And I think that today, it's pretty clear that the investment clock somewhat correctly forecasts what asset you should be in. So Trevor Greetham in 2005 went back to the 1960s, however long he had data. First he had quarterly data, and then he went to 1970s where he had monthly data, and he recreated this investment clock. And he said, well, I know I should own bonds here and stocks there and commodities in the third quadrant and cash here. How would that have done? And it worked perfectly well. I mean, it worked really nicely. Really? And the Hedgeye guys have now taken that approach and extended it, like which factors work best in which quadrant. And they've kind of gone one step deeper than what Merrill Lynch had done in 2005. But the thing that they haven't done yet was a second step that Trevor Greetham did, which was, he said, well, if God told you what is going to happen in 3 months, and you invested today knowing that investment clock was going to flip over from one quadrant to another, how would you have done? And the interesting thing was that you did relatively poorly.
Really?
Having perfect foresight and investing based on the investment clock principle 3 months too early at times led to some horrific losses. Oh. And the best outcome was if you basically worked in the present. If the closer to today that you could figure out where you were in that quadrant, the better your performance ended up being. And if you were 3 months too late, you still beat the performance of the person who was 3 months too early.
Really? Because you always hear all these stories about the stock market and financial markets be discounting mechanisms, and yet doesn't this fly in the face of that?
I'm not sure if it flies in the face of that. I think it's just that, over 3 months, a lot of stuff happens. So you're 3 months early. In the meantime, let's say you're supposed to, that inflation is going to come down and growth is going to turn over, and you're supposed to be long bonds. But in the meantime, something bad happens and oil prices go up $15 and the bond market gets crushed.
I just would have thought that by the time inflation's here, the bond market's already priced it in, and therefore being early would have actually been beneficial.
Yeah, well, it just shows you that it's not.
So
I think what it basically tells you is be present, right? There's this Danish philosopher, Kierkegaard. Kierkegaard lived early 19th century, and he was one of the first existentialists.
Okay.
And he said, what makes people unhappy is being absent.
Ah,
Well, being absent means you're not present,
right.
because otherwise you wouldn't be absent. And in order to be absent, that means your mind has to be either in the past or in the future,
Okay.
right? So I think of this as the Kierkegaardian approach to trading is be present, right? Focus on what is happening today and try to go with the flow. Forecasting is, as we all know, super difficult. There's lots of studies about how badly we do it. But backcasting, looking at history, is also not that easy because data can be pretty messy.
Right.
Right.
Yeah.
So let's say you believe in the investment clock approach,
Okay.
and you ran it in Japan.
Yeah.
And you're going to look at GDP up versus down and inflation up versus down numbers. Well, we had a study done. Well, one of my interns did a little study for me.
Yeah.
Since 2004, quarterly Japanese GDP data. So we've had, what is that? That's like 16, 17 years times 4. We've had like 60 observations. 16% of them flipped in sign between the day they were announced and the final revision.
Right.
Well, so yeah, if you run a model looking back and then find out that the data that went in was absolutely revised, it's kind of like garbage in, garbage out.
Yeah. No, that's something that I know is a huge problem, is that people look back and they don't realize that they're looking at data that has been changed after the fact. Like even, every single number we look at, in terms of the US, think about it. They're revised the next month. And so when you're sitting there and looking at it and you're saying, oh, the bonds reacted this way to the data, if you're looking, a year ago, you're looking at the revised data. You're not looking at the actual data of that moment. And that is one thing that that's kind of one of those logical things that traders might know, but people that aren't familiar with the markets that come in and try to, crunch numbers might miss.
Yeah, no, I think it's super important to think about point in time. Like at that point in time,
Right.
What would I've actually seen? And, like when I look at that base rate and the green dots and the red dots, I know that is not messy data. We know that the stock market in 1992 did this.
Right.
That's not a number that's going to be revised.
Right.
But, as you say, if you're looking at something like the investment clock, I think you need to be much more careful. And when you're running historical performance on a certain type of model, you need to understand that what you're looking at might very well be revised data, and you should really go back and change it.
Well, Jim, one of the things that as I've gotten to know you a little bit and learned how you trade, I'm fascinated by how much number crunching and how much data you're actually going through. I'm sure you took the time to kind of go through all your different studies that you have and stuff. Would you mind just talking a little bit about the things that you've created and what your day looks like and what the kind of things that you're looking at in terms of the market? Because I think that it would be really beneficial for people to understand, how you go about digging through some data, looking for ideas.
Well, I think probably the first thing I don't do every day, but maybe once a week, is to look at large changes over the previous week.
Okay.
I look at macro, so I might look at all the currencies and say, oh my goodness, like the Peruvian sol suddenly moved up a lot. I wonder what's going on in Peru. I might look at tech companies in general and look at, the components of the XLK,
Right.
and see how have they done and how come one of them didn't do as well as the others. There's like an outlier in there.
Yeah.
I look at seasonals.
Right. Which is really surprising to me how much you look at that, and you obviously very much believe in it.
No,
No?
no, not at all. Seasonals are a lot of garbage in, garbage out.
Okay.
Sometimes they help you make money. I think if you take seasonals too seriously, you tend to overvalue them, overweight them. But
Okay.
really think of like you were talking about going to the casinos, like flipping a coin 16 times and getting 12 heads. Okay, it's going to happen. There might not be anything special about it.
Right.
However, last month or a month and a half ago, I made money buying the S&P because from March 29th to April 29th, the S&P went up 16 times out of 16.
Okay.
And I said, maybe that's random. It's quite possible, but maybe there's something underneath there. I mean, 16 out of 16, I'll take a flyer on that.
So wait, so you had found something that over the last 16 years had been S&P up, and you had decided that I'm going to go and bet the 17th time it'll be up. Is that correct?
Yeah, or it was 15
Okay,
at this
fair enough.
the 16th time or something like that. But yeah.
What I love best about that thing is that a lot of people look at those things and they say, oh, 16 times is due to fail, and they're going to go the other way. And they're not realizing that, like, Patrick is putting up his hand and saying that it's due to fail.
It's me.
And I always kind of laugh about the reality is that if someone presented you with 16 coins that it flipped heads 16 times, my assumption would be that the coin's not equally weighted, and that you should and there's an edge there, and that you should probably go with the heads, not against it. And is that would that summarize your thinking there?
Yeah, definitely. I mean, I think the coin, for some reason, is probably biased over that period of time.
Right.
Whatever mechanism is biasing that coin. So we have a little program that does this seasonality analysis every day. And, it throws out anything that's 80% plus.
Yeah.
It tells us on a little screen, over the next 1 week or 1 month, you should expect, this is what happened the last 10 years, and 88 times out of 10, it went up
right.
or went down. And, that gives us something to think about.
Yeah. And so I guess what you do is you use that as a little bit more, like you might already be bullish the S&P, and that'll just help your trade along, right?
Yes. And then you do a little bit more.
Right.
You buy a couple extra calls, or you buy some more futures, and
yeah. I was fascinated to find, though, like that you did go and do that seasonality, and that you did have quite an extensive program to find those things. You probably, even though you kind of you joke and you say it's not the holy grail, yet it's obviously something that you believe in enough that you're watching all the time.
Well, I think there is an enormous amount of noise and information that comes at us. And we need to somehow curate that. And looking at seasonality is just one of the ways to curate. Oh, you should look at this because, 8 times out of 10, it moved up. Yeah. Well, okay, I'll look at that. Right. Because I walk in the morning and I don't know what to look at.
Right.
So I rely on curation via friends. So I consider you a friend, and I read your little macro tourist piece. Love it religiously. So about 4 days ago or so, you wrote about the RP, the repo market.
Right.
Well, since then, we've traded the RP twice.
Okay.
I made money both times.
Oh, that's good. I'm glad.
Right? Because you wrote that little piece and it said, well, at 1:30, the news comes out and this is where you can find it. And then, so Derek, my intern, wrote a little program, and it calculates how much of a downside we should expect on the S&P if the RP comes out at certain levels. And we trade it. I mean, I don't know how long we will trade it. When it stops working, we'll stop doing it. It worked yesterday and it worked the day before. Right. So
I've always said that is actually the most difficult thing in terms of curating all the information that you have. Like, where do you put your time? And you're absolutely right that finding people and friends and others that you rely on to sift through that data and help you decide what to focus on is so important.
Yeah, I think so. You need to have methodologies to cut through the noise.
Yeah.
Otherwise, you're just totally swamped.
Yeah.
And I think, one of the reasons macro investors did poorly from, say, 2008 on to 2020-ish, 19, during COVID, I think macro just woke up again and things started happening. And, people were much more successful in general. However, during those 10 years, the amount of noise increased dramatically. Dramatically. I mean, I know because I look at my emails and I get like 2,000 emails a day now, and I used to get 200 emails a day.
Right.
It's not like there are 10 times more signals in the world. It's not like more things are happening. It's just that more people are writing you, and just to cut through that is so, so difficult. And I think, you need to be able to step back and just have a couple of easy ways to cut through the noise. And I believe that friends matter a lot,
right?
Because they don't waste your time. Like they send you something because they believe they've done some kind of research. They reach out. It might be a paid subscription. It might be just a friend who wants to chat and vet their own idea about the world.
Yeah.
And then there are these little systems that help you look at, what moved a lot? Because if it moved a lot, there's something going on, and then maybe you should start spending time on it, think about it. So I think that kind of approach helps you cut through the noise. And then, the old listening to the game master part, every day there is new listening to the game master. If you I like commodities because we're in this quadrant where growth is up, inflation is up, commodities go up. Well, what do I buy in terms of FX? I buy, obviously, the Canadian dollar because it is somewhat linked to the commodity cycle.
Right.
Now, who do I have to listen to? Well, the governor of the central bank. So the day they cut back on purchases from 4 billion to 3 billion, he's speaking very clearly to me.
Right.
He's saying, whoa, there's something changing here. And you had plenty of time to buy more Canadian dollars.
Right. You're absolutely right that a lot of times people, they put their own value system or their own ideas on what the game masters, as you so rightfully call them, are telling you, and they don't listen. And I'm always fascinated at the market's reluctance to listen at times.
Yep, I agree with you. Because otherwise the market would adjust way quicker and way more efficiently.
Okay.
This gives us a chance to actually get paid for working.
For listening to the game master.
You have to listen, and you have to then react, which is difficult to do if you are at home and having another job. Let's say you are a professor or dentist and you're doing your own thing. Well, then maybe you'll hear about the game master changing the QE function in Canada 24 hours later.
Right.
I hear about it within a minute of it happening, and the price dropped. I could see it on the screen, but it didn't drop by nearly enough to, Canada turned into, I think, my third best performing asset this year.
Oh, nice to see us Canucks helping out. When you spoke about the Game Master last time you were on the show, we had a lot of people reach out, and one of our listeners, he actually had a question for you, and he says, when it comes to listening to the Game Master, how do you do that in places like China, where the Game Master is either opaque or has alternative motives? So
there's a problem with China anyway, because I don't speak Chinese, right? So how many of us do?
Yeah.
Some of us are lucky enough to be able to actually read the local news and the local papers, but in many cases we have to rely on an interpreter.
Okay.
And I tend to rely again on friends who have made the Chinese ecosphere their bailiwick. So, for example, a friend of mine, Jing Tsu, a professor at Yale, runs the Council on East Asia, and she will have forgotten more about China between breakfast and lunch than I will learn in my lifetime. And, when she says something to me about China, I will listen very, very carefully because she knows a lot more than I will ever know. And on a less personal level, I read Bishop's Sinocism. There's daily facts by a Chinese speaker who analyzes, speeches by different levels in the politics and in the economic sphere in China, and it allows me to get a sense of what is happening in China and what the game masters want. So, the CNH, the Chinese currency, is my largest currency position, and it's because the Chinese over the years have spoken about internationalizing their currency. The dual circulation economy, which means they don't want to only be dependent on the export markets.
Okay.
They want to grow their internal market.
Yeah.
Makes perfect sense. We see the internationalization by the opening up of the Chinese government bond market.
Yeah.
Right, so you have positive carry because those bonds, the 10-year bonds, are trading around 3%.
That's right. The only positive real yield, like in the developed. Well, I don't know if you call them developed, but let's face it. In terms of the big markets, it's the only place you can get a positive real yield.
Right. So it makes perfect sense to put all that together, listening to them speak, and be an investor in long-dated Chinese currency, which is priced off the bond market, obviously, off interest rate in China.
So let's talk a little bit more about that, because you say that this is one of your biggest currency positions. And I know that traditionally, when you go and you get on FinTwit or you listen to these hedge fund guys, they've traditionally been very bearish. Like it's been just constant barrage of how the Chinese is going to fail. And, that started with certain guys getting there and showing you, videos of the ghost cities and all, like the negativity around them is just shocking. And yes, there's no doubt that the Chinese do some bad things on, in terms of like on a humanitarian basis, but let's just put those aside, because let's face it, the reality is that a lot of countries do bad things. And if we started to, as investors, make moral judgments every time we did a trade, it would end up being very difficult. But in terms of going back to the negativity that we're seeing, you're invested in a currency that seems to be almost everyone hates, and most people think it's a disaster walking out there. How do you reconcile that, or do you just view that as the wall of worry that your trade's going to climb?
Yeah, I think it's a double-barreled thing. Number one, it's the wall of worry. Yep. And number two, it's people getting stopped out. I'm going to keep driving my trade higher and higher. But I think it's not even that important what everybody else is thinking. When you just look at the current account surpluses and the foreign currencies that have been built up on Chinese corporates, exporters' balance sheets that they haven't sold yet, it just tells you that, once the trade war rhetoric had worn off, and, for a brief period of time, the Chinese currency weakened above 7. It went from about 620 to 715-ish. Yeah. But when it broke back down under 7, I thought that was an interesting signal that the Chinese would allow that to happen, even though we were still in a Trumpian trade war. And I think they must have at that time said to themselves, great powers don't have weak currencies.
Okay. And so now this is a change in kind of attitude amongst the Chinese, because for a long time they were, keeping their currency too low, and that's how they were achieving their economic kind of superiority, is the fact that they were, trying to export their way to growth. Now, do you think this is indicative of change in their attitude, and it's something that you're going to be able to be long for a longer period of time?
Yes, I'm convinced of that. I think the whole idea of the dual circulation economy is super important. Now, if you want to build a strong local economy and kind of diminish the global risk your exporters are taking, like if you don't want to only depend on your exporters doing super well.
Right.
You want to have a local economy that is driving output and employment and not have to worry about somebody outside deciding that they're suddenly not going to buy your goods or putting tariffs on you. I think it was a key element. And having a stronger currency allows the development of the local economy because it puts a little pressure on the exporters to become more efficient.
Yep.
And it makes it a little bit harder, so people start focusing more on the domestic market.
Okay.
And it gives more purchasing power to the domestic consumer.
And so when you recognize this, you mentioned the fact that it went during under 7 during the Trump kind of rhetoric. Is that often something that you recognize like a strength that you're not expecting as something to investigate and almost a signal for?
Yes.
Okay.
Yes, totally. When you don't expect something and it happens, it should be a wake-up call.
Right.
Right. So when it was weakening, I had no positions.
Yeah.
I didn't know. Plus, I don't like paying negative carry. And I knew a lot of people who had bet on negative China and negative Hong Kong, and the peg is going to break and the world is going to blow up. And then it started strengthening. Not a huge amount,
right,
but by enough to kind of ring a bell in my head and say, hey, you should look at this and think about it and read about it and talk to friends about it. And when it hit 695, I started buying 1, 2, and 3 year digital options.
Of course.
And I still, some of them have matured, and then I bought new ones.
Yeah.
And now it's trading at 636, and I've stopped buying new ones. The last ones I bought was around 650 or so when I bought them. But I do think we're going to 6 and lower.
Okay.
And those are very cheap because the volatility is cheap because the central bank kind of massages the ranges. It doesn't allow crazy volatility, and people price options not off where they think things will end up, but off daily volatility.
Right, because they can delta hedge and actually realize.
Delta hedge.
Yeah.
That's their job, right?
Yeah.
So it's actually like a large risk arbitrage because I never delta hedge.
Right.
I couldn't care less what happens in between, right? The other person delta hedges. So we're living in different universes. We can both make money.
Right.
And this is perfect. This is the greatest thing because people like making prices to me. And I like finding prices. I think, the same thing happens in long dated equity options because there are lots and lots of call sellers.
Okay.
Right? Because they want to earn some kind of yield against their actual portfolio. So if you look at the volatilities on puts versus calls when you're out of the mid-strike,
right?
The puts are trading at twice the level of the calls.
Right.
So it's always cheap to buy long-dated calls.
Yep.
Because number one, I believe you should be an 80-20 rule.
Yeah.
80% green dots. So you want to buy those long-dated calls. And they're cheap because I'm not delta hedging them. They have lots and lots of supply of them. So until more people wake up to the fact that long-dated equity options are too cheap, then that risk arbitrage is going to continue.
And do you think that you could see a situation where we actually do get a smile that is not so much of a smirk, meaning that the calls end up being more highly priced?
I think at some point, institutions are going to wake up and say, this is better than owning the underlying.
Right. Oh, you think they might even turn into buyers of it as opposed to stop selling it because they'll realize that they can replicate long positions through this in a cheaper basis. And I guess, to some extent, we've seen this in individual stocks with like GameStop, AMC, where the skew is actually, it's scarier on the right side because it's infinite tail. Right? Right?
Yeah, totally. I mean, I think puts actually are less risky because the stock only goes to zero. Right? I mean, it can't go negative. Yeah. Whereas on the upside, it can go up 100%, 200%, or as in the case of GameStop, at one point it was up 500% or whatever it was. I mean, it went from like $4 to $500 during one of the nights.
Just crazy. Like, I don't know about you, Jim, but if you had told me a year and a half ago that the GameStop and other these stocks were going to do this, I wouldn't have believed you. I would have thought you were high.
I think this is a super interesting conversation because we should dig into that a little bit more. I have had previously believed that institutional investors were really the most important thing in financial markets.
Okay.
And then when GameStop happened, I was talking to a friend who is a retail analyst. He swore to me that the stock is not worth more than $20. I mean, it was trading at 150 that day we were talking, but he was swearing that it wasn't worth more than 20. And I realized the power of the new retail investor.
Okay.
I had never focused on it. And if you go to SSRN, Social Science Research Network, where they post new research on all kinds of stuff, and just type in retail investor, lots of it has been written about it. And retail investors over the last year have had a large impact. So Robinhood crowd is about 0.2% of what's happening in the markets.
Yeah.
But they explain about 10% of the variance on stocks. And according to some research that I was reading, up to 20% higher small cap stocks than would exist without them. And one of the reasons is that the large institutions tend to be passively managed. So like when GameStop goes up $100, $200, they don't look at their portfolio of Russell 2000 stocks and go like, oh, we have 37,000 shares of GameStop. We should just sell those now. No, because then they wouldn't be passively invested anymore.
Right. Okay.
Right? So there is nobody on the other side except hedge fund guys who went short and got buried.
Right.
So I think it's really interesting to start realizing how important others are in the world.
Okay.
Number one. And number two, like I started reading this Reddit Wall Street Bets when that started, I mean, about 4 months ago.
Yeah.
And I read it every night before I go to bed. And it's great. I mean, I lie in bed before I go to sleep. I look at, what are they talking about today? Oh, it's Rocket or it's GME and crypto and, and I'm actually rooting for them. I want them to win. I mean, they are so enthusiastic. They are so well connected to each other. There's very little negativity on that website. It's kind of fun, and I think that it's important to know what other people are doing. So, my retail analyst friend who said, well, it can't be worth more than 20, he obviously didn't look around the world and say, well, what are other people thinking?
Right.
Which I think gets us back to, I thought we could do something else interesting.
Okay.
There was this, you guys all know about Keynes.
Right.
And Keynes was a very well-known investor during his lifetime. Yes. He was managing King's College endowment and did super well, and people would come out and visit him and ask him for advice. And one of the things he talked about was that the stock market was just like a beauty contest.
Okay, yeah.
And that your job wasn't to identify the most beautiful. Your job was to look around the room and say, who are they going to vote for that's going to be the most beautiful in their eyes?
Right.
Right? Because I'm playing around in this market where all these other people are also trying to find the right stock.
Right.
And what that really talks about is knowing what other people are thinking and how they are positioning and what is important to them. And one way people have replicated that, it's a cute game where, I've done it in classrooms where you say to the class, well, choose a number between 0 and 100.
Right.
And choose a number such that your number is 2/3 of the average of the number that everybody picks.
Okay.
So you have all these people in class, they're all picking a number. We're going to later calculate the average of all the numbers, and whoever's closest to 2/3 of that number is the winner. So if we think about that, like how would you approach that, right? You're supposed to pick a number between 0 and 100. So if you just randomly picked, right? 50 would be your average number.
Okay, yeah.
Start with 50. So 50 is your kind of like set point. Now, if you're at least listening to the instructions, you'll take 2/3 of 50.
Okay.
Because you think, okay, everybody else did 50 because they didn't listen. Well, I'm going to do 2/3 of 50. So I'll do 33.
Yeah.
Write down 33. Well, then you start looking around the room and go like, that person, she looks like she's listening. She's probably going to write 33 also. And that one over there, they're listening. So maybe I should do 2/3 of 33 because I'll be second level. I'll get ahead of those people, right? So then you write down 22. And ad infinitum. I played this once with a couple of math guys, and there were a bunch of zeros because they just kept ratcheting it lower and lower and lower. Like they would say, well, like he's a math guy. He's going to go one more. Yeah. And eventually you get to 0. But 0 never wins because there are always some people who give you positive numbers.
Right.
So
it only works in a room full of mathematicians.
And then sometimes not. So I was reading this paper by Montier, who is at GMO now.
Right. Okay. Yeah.
And
I think he's the guy who always wears the funny Hawaiian shirts, I believe. He's a great guy. Yeah.
So he wrote a paper around 2005 or so where he actually looked at all the research on this game that has been played hundreds of times. And the board of Caltech, average number was 45.
Really? Wow, that's fascinating. Okay.
And this is from his papers. I've never gone and dug into the number because I don't care. But when I just Googled, like what was the last or the biggest game of this Keynesian beauty contest game, it was played in Denmark and was done by a newspaper. 19,200 people participated.
Right. How about we don't tell people because we have or do you think we should tell people?
Yeah.
Okay, tell people what it is. Okay, go ahead.
That number was like 21.5 or something like that. So it was two-step thinking. Two-step thinking gets you to 22.
Okay, because
So I think we should play a game with all the people who listen to this podcast. And I know you can somehow set that up nicely.
So Jim actually reached out and told me this, and he had volunteered to take all the emails. And I was like, oh my God, you don't want to be doing that. So we figured out a way to create a Google form where you can put your answer. And so what we're going to do is we're going to give the link, and I'll say it out right now. I made a link that is Cutly. So it's CUTT.ly/Jim Leitner 2/3. And 2/3 is spelt out TWOTHIRDS. So again, CUTT.ly/Jim Leitner 2/3. And we would appreciate it if everyone goes and puts their answer. We're going to get you to repeat the question one last time so people understand what they're responding to. And then you were so kind to say that the winner is going to get a signed book of House of Money. Is that correct?
Yes, exactly true. I will mail it personally with a nice note.
That is
and I'm looking forward to seeing them on Zoom.
Very kind of you. I don't know if before we go, I'll just tell very briefly how we came to meet. When I was writing a piece at one time, I came up with this idea that that I remembered that there was some guy out there that hedged against negative interest rates way before negative interest rates ever existed. And I sat around and I thought it was in Market Wizards. And I was like, who is this guy, this genius guy that had kind of talked about the possibility of negative rates years before and had been buying something and decided that he wanted to buy puts, basically rate puts below zero, even though it seemed like it could never happen. Somebody said, oh no, that's Jim Leitner. It's in House of Money. I went and dug up my House of Money. I wrote my piece and then it was sent to you and you were so kind and you reached out and you said, I remember your line. You said, it's been a while since I've been in the news. My wife is really impressed. It was something of that nature, and you were always very nice about it. But the House of Money, I will forever be I found that your interview was one of the greatest. It was so great, I thought it was Market Wizards. I think it should have been Market Wizards. You definitely deserve to be in there. So why don't you tell people again what it is that the answer to the question that they're going to put in when they actually go there and put their answer.
So the question is, pick a number that between 0 and 100 that is 2/3 of the average number that everybody picks. So I will calculate the average on everybody, and whoever is closest to 2/3 of the average will be the winner.
Okay, we're going to try to beat, we're never going to, well, I shouldn't say never. A good trader never says never. Chances are we are not going to beat the Danish study, but it sure would be nice if we would get, many thousand and we get a whole bunch. And it's going to be all automated, so it won't be that much work for your intern that you've volunteered, to be slaughtered and do all this work. But so, again, the website to go to put in your answer is Cuttly, CUTT.ly/Jim Leitner 2/3, and that's spelt out. And Leitner is Leitner. Well, that's great. I'm looking forward to it. I'm going to go put my answer in, and although actually we probably should be that we can't win. Yeah, you know what?
We can't win. I'll put an answer in, but I won't win either. I want to meet people who are smarter than me. I love meeting people who are smart and giving me ideas.
Well, my problem is that just like your question about what to bet on in terms of the green and the reds, to me it was always like 100% green. Like I was very quickly like, there's no point in betting anything else. I'm kind of now like, well, isn't 0? And then I'm like, yeah, but you're right that maybe not everyone is. So where is it? And how many iterations do they go? And how many times? There's a lot of like game theory here. It's terrific stuff.
Yeah, it's fun. I really love thinking in probability space. And I think it's fun to do it with other people because we are communal. And I think the nice thing about financial markets is that, even though there's a competition to do well, you don't do any worse by sharing your ideas. Wow. I've never felt that I should hide something. Yeah. I love sharing my ideas.
I think, Jim, you are truly a unique individual, and you are very giving with your time and your ideas. And I wish the whole world was more like you, because we would probably be a better place. But unfortunately, your attitude is not nearly as pervasive as it should be.
Well.
Now, listen, while we have you, last time you were here, I asked you for your favorite books, and one of them was the Checklist Manifesto. And one of our readers went and he actually read it, and he said, as a trading manager, I want to develop a checklist that is like for doctors, simple, quick, and heads off common errors. But it's tough to find something with wide trading applicability that doesn't wind up looking overly bureaucratic and cumbersome. And he asked, what is on Jim's checklist? What are the elements of a good trading, investing checklist, and how do you go best about building one?
So I'm not sure if mine is a great checklist, but I'll tell you what's on mine. The first thing is an up and down probability. Right? I like XYZ. Well, how certain am I that XYZ will happen? So let's say we take the Chinese currency thing, and I say, I think it's going to appreciate over the next year. Well, what probability do I assign to that? Right? So I say I'm 65% certain that is what's happening. Number one. So that means I'm 35% not certain.
Okay.
Right? I mean, it's got to add up to 100. So number two, I put down how far do I think things can go? I don't just do, up and down. I also say, well, I think if I'm right, the currency is going to 620 by next year and 610 and 6 over the next 3 years. And on the other side, it might be back up to 7 for some reason.
Okay.
So the third step, I calculate the expected value. I just multiply the two things out. And if the expected value is not positive, I say, good, checklist. It worked out well. I didn't do that trade. If it's positive, I say, well, okay, it's a positive expected value. I don't have to do this trade, but now I need to start thinking and focusing on it. So the next thing I do is I calculate the Kelly criterion on these probabilities and outcomes. I think we mentioned that in the last podcast.
We did. You could just briefly just summarize it for everybody.
So, the Kelly criterion allows you to calculate an optimal leverage ratio. It can be under 100, it can be over 100, depends on what kind of volatility the bet has. And in my experience, it's way too leveraged. Right. I can't sleep if I actually bet the Kelly criterion. I bet 1/10 of the Kelly criterion.
Okay.
I think 1/10 lets me sleep and it has positive expected outcomes, so I do that. And then the last line on my checklist is, what are the sources of this positive expected value? Is it because of carry? Is it because I think the politicians, the masters of the game, want this to happen and it's in their power to make it happen? I just make myself like a little note.
Okay.
And then I think the other important thing is to kind of keep the probabilities updated. Not to say, I put this trade on a year ago, and, at that point, the probability was 65-35, and now new stuff comes out.
Yeah.
Well, when new stuff comes out, you need to update probabilities. There's a wonderful book called Super Forecasting by Philip Tetlock, which I think, if you finish the Checklist Manifesto, read that. If you don't want to read the whole book, in the back, there's an appendix with a summary of how to be a super forecaster.
Fair enough.
So you don't have to read the whole thing.
Okay, speaking of super forecasters, we're going to put you on the spot a little bit here. One of the things that you mentioned to me earlier was that you think that inflation might not be the long-term problem that many are talking about in the news and in the FinTwit and stuff like that. Why don't you walk us through your thinking of why we might be all panicking about inflation incorrectly?
So I think there are several reasons, but the main reason I see is that I'm a believer that productivity will improve over the next 5 years. When you look at productivity numbers going back to like 1960, every time after recessions, we had jumps higher, where people during a recession learned how to be more productive, because otherwise they were going out of business. And once the recession was over, it's not that they suddenly forgot about how to be more productive. We're going to keep using Zoom when this recession is over, when things are coming back to life. Lots of technology that we've gotten accustomed to working from home is going to continue to be with us. And I think that the impact of AI, robotics, with the entire channeling of supply chains back to one's home country, where people now are more nervous about having their supply chain be as far spread out as it was at the beginning of COVID. Any new factories are going to be built with smart manufacturing.
Okay.
And with robotics. So, having AI, having robotics, having 5G and autonomous vehicles coming over the next 5 years, I think we'll have a productivity jump. And productivity jumps in the past have been associated with lower inflation. So if you do a chart and you just take productivity on one side and inflation along the x-axis, and then you just say, 1960, the number is here, and in 1970, the number is here. Then you draw a line of least fit, or best fit, least error. Then you see that higher productivity is associated with lower inflation. And that makes perfect sense. I mean, higher productivity means you're creating more GDP with the same number of resources.
Okay. Right? So now are you actually expressing that with a long bond position? Like, do you think we're at the point where there's a trade to be have, or it's just something that you're watching for? And this is almost like your bias. Like you're thinking that for the next 5 years, there's going to be more greens on the disinflation than there will be on the inflation.
Yes, that's exactly how to put it. And I haven't done a bet on it. I mean, I would say that some of this disinflation will feed into the equity market because, higher GDP growth leads to more profits, leads to higher salaries.
And if we have more growth with less inflation, with lower interest rates, it's a nirvana for the stock market. So one of the things that you have done a bet on, if I'm not mistaken, is uranium companies or uranium itself. And
yes.
Why don't you walk us through your thesis there and what you're seeing and why you like it?
Well, I think it ties in with the climate change discussions that have clearly now come to the forefront.
Right.
And, our economies need stable sources of base energy. Like, it's great that solar has become so cheap. It's great that wind energy is so cheap. However, I have a feeling it's not enough to only have those renewable resources. And if you look across the world, nuclear power is way safer than what is commonly assumed. We're always afraid of the things that we read about and hear about that really don't happen that often.
Right.
So we have a blow up in the Ukraine, and yes, that was a poorly run nuclear plant. In Japan, when we had a problem, people died, but it wasn't from nuclear exposure. They died because they had heart attacks, escaping and leaving the area. So I think, when you look at it, countries like France, for example, have more than 70% of their electric energy being created by nuclear power plants. There are 50 new nuclear power plants being planned around the world over the next X years, however long it takes to build them. Of that, I think something like 14 are in China. If people want to reach climate goals,
right,
there is clearly a case to be made that part of that will come from nuclear. And in the Biden administration, in their plans, there is money allocated to a uranium stockpile. So if you look at the price of uranium in 2007, it was something like $200 per pound. Now it's down at 30.
Yeah.
And there is a deficit in terms of demand versus supply that is being filled out of inventories.
Yeah.
But that can't go on forever. And, that makes me think that over time, the price of uranium will go back to 50, 60, and maybe even higher. And to me, the easiest way to take advantage of it is to buy, uranium producers, CCJ, which I think when uranium hits 60 will double or triple.
Okay.
Right now it's trading at 20. I bought mine at 12. I have long dated options on it. Also, besides the cash position, our intern who built a little model around different prices for uranium, what would it do to the stock price, comes up with a price of about $50 for the stock if uranium goes back to like $60 to $70. And, I think that the probability of nuclear becoming more of a buzzword over the next 4 or 5 years, with climate change being such an important issue, is higher than 50-50.
Right.
And so I like it. I mean, I like that, and I like Electrobras, which basically doesn't have any coal-fired power plants. Right. Same idea. Why would you not want to be in the utilities that are clean energy?
Okay, so Jim, we're getting to the end of our discussion here, and I was thinking about something fun that I could ask you. And you're a man of history. You're a man that's read a lot, and I've decided that this is the question I'm going with. If you could go back and talk to any historical figure at any time, like I've given you a time machine, and I said you can go back and talk to anyone you want, who would you talk to and why? Now, I didn't warn you, so I'm going to give you a little time. I'm going to kind of talk while you're thinking up something.
Super difficult. I don't know. I mean, this is really hard.
How about investors? Who would you go?
I would talk to Keynes.
You would?
I would want to know what he was thinking, what made him such an excellent investor. I mean, in terms of things that we have talked about. Would I like to go back and talk to Kierkegaard? Yes, my Danish is weak, but I would hope he spoke enough English so that we could speak in English or in German together. But Yeah, I think, if it's just among economists and investors, I would just go back and want to sit down with Keynes and find out, what made him such a special individual.
For sure, and we're all still talking about him, and when you start digging in there, you just learn more and more about him. So listen, Jim, it's been a pleasure having you. Before I let you go, I realized Lena has reminded me that we did not put a deadline on our little contest here. What do you think? What should we do?
1 week or 2 weeks? You think?
No, you know what? Why don't we do it so that we can announce the results next week on our show? So we're going to put the show on Saturday. So why don't we say Thursday night? Does that sound fair?
Okay.
So
Yeah,
then we'll spend all Friday doing it. So it'll be Thursday night. We'll do it. And one last time, I'll give everyone the link. It's Cutley, CUTT.ly/Jim Leitner 2/3. Now, before we let you go, why don't you tell people that if anyone wants to kind of chat with you or reach out or learn more about you, where should we point them?
Send them to my email, jleitner@falconmgt, MaryGeorgeThomas.com.
You are too kind, and you are a brave man putting that out there. Jim, it's always a pleasure to have you. I thought this was just a fascinating discussion, and I'm looking forward to our little study in terms of seeing how it works. And I just want to thank you so much for your time, and I'm looking forward to doing it again sometime.
Sounds great to me. We'll do it again in 3 months.
Sounds good. You say that, and you might regret it later. But thank you again. We really do appreciate everything, Jim.
Take good
thanks,
care.
Jim.
Have a wonderful long weekend.
Take care. Okay, Patrick, it's time for Talking Charts. What do you have for us this week?
Okay, before we get to the charts, as always, let's go through the top 3 things we were watching last week. And, you nailed it. We'll talk about it in when we get to the bet. But post-OPEX volatility never did come back. What a quiet week going into Memorial Day weekend.
It's a shock.
No, it's not for you. Not for you. It was a shock for me.
Number 2.
Can the FANG stocks turn back up? And this continues to be a very important theme for me. This is the FANG futures. They've turned up, but they're still lagging on that side. But there are some individual components of the FANG index that are showing some signs of life, but really they haven't really caught on fire in any way. And I think that in order for the U.S. equity markets to really get going, this will have to join the party. I mean, I know you have a little bit of a more neutral view on that, but I still stand in this camp.
That's what makes a market. Number one.
Number one was lumber, right? And we were saying, well, will it be able to punch new highs? We were talking about, what was the resistance level that I gave you?
I can't remember.
1,500. Where did it stop?
Oh, it's almost like you know something.
Oh my God! But anyway, so it's stalled.
For you.
It's stalled. Now you know what? Sometimes I get lucky. But it's stalled at 1,500. It's been bleeding out. I mean, at this stage, the price action.
You make it sound like it's like a Vietnam War movie. It's been bleeding out.
But it's starting to lose its mojo. And that's the worst thing that can happen in something that's gone parabolic. Ask any of the crypto people how that feels.
Yeah, or ask Austin Powers. He spent like three movies trying to find his mojo. So,
and so the point here is that with lumber backing off of its highs this way, maybe the bulls can still pull off a save here and punch it north of 1,500 next week. But if we get more of the same next week, I'm calling it. There's an intermediate top in lumber. Give it one more week, but so far doesn't look good. Let's go to the top 3 things to watch next week. And what did I text you? It was number 3. What did I text you, Kev? It's like, is anybody talking about the Chinese renminbi? And because I thought it was really interesting, and it's funny that Jim brought it up in the
we didn't even know that actually, because you really did say that. You said, is anyone talking about it? And then Jim says it's number 1 holding.
There you go. And funny is you were like, I'm in it too. Anyway, but this is interesting. So here's that U.S. dollar against the renminbi chart, and it broke to a fresh low. And it's interesting because obviously we keep staring at that dollar index and the euro and all of these other currency pairs, but the U.S. dollar has just been breaking down, and you know what? Nobody's noticing. I haven't heard anybody really start talking about this. It's like a quiet, stealthy breakdown.
There you go. You're right, and it's a great trade. The people,
but
haven't
the question
realized
is,
it carries terrific. That's what Jim mentioned that briefly, but it carries terrifically as well. You're just looking at the spot, and you're not realizing that the actual carry on top of that is even better.
So, like, if you look back to where the 2018 lows were. They were, let's just round it off to 6.25. It'll be interesting to see whether that's where this trade targets next on the downside. All right, so number two is the G7 meetings next week. What you watching there?
I think you have to watch it. Listen, more and more governments are a bigger part of the economy, and although we might not like it, it's the reality. So if we have some G7 meetings, you have to watch. Listen to the Game Master, as Jim reminds us, and I think therefore I put it on there. That one's mine. It might be a complete dud, and maybe we'll look back and say it shouldn't have been there. But personally, I'm watching for
But what do you think can happen? Do you think that it's going to be?
I don't know what's going to happen, but it's definitely something that you should be aware of, and you should be watching for changes of tones. You should be watching for strife amongst them. There's lots of things that potentially could happen, and the fact that nobody's talking about it is almost all the more reason that you should talk.
But
talk about
things are so quiet I can't believe how few of these kind of major macro things are being talked about right now. Like, everyone seems so focused on the crypto stories and other things like this that they're not. These other things have just lost all headline criteria. Like, no one's doing it. Anyway, number one. Has the next bull market advance started on a lot of equities? And, we saw the S&P 500 advance. We got to start with the S&P just to give it a lip service. But, I still believe that the FANGs are an important role in this. But one of the interesting things that I was noticing in the markets overall was that when you look at the global equity complex, right, you start here with the Nikkei. The Japanese Nikkei turned right back up, ready to almost head right back to their highs. You look at the Euro stock, broke out to a fresh new 52-week high. We have emerging markets coming to life. Look at the way China's A50 popped out of that 3-month trade range to the upside. You have the India Bombay market with the Sensex heading right back to its highs. I mean, the global equity complex has started to come to life here on the upside. And, one of the things I'm always a little bit bearish when the market turns over, just in case it is one of those 10+% corrections. But whenever we have one of these pullbacks in equity markets that, lasts a couple weeks and then kind of cleans everything up and resets the overbought state of the market, when it turns back up, you never know whether the next bull leg is about to advance. And the way the global equity is turning up, I think it's worth watching. That's number one thing to watch for me.
Okay,
anything you want to add to that?
It's a little bit of strange environment when you're all of a sudden talking bullish on stocks.
I'm watching to see if it happens. I never said I'm forecasting.
I understand. Usually you're watching for the end of the world, and it's interesting. It's a little different.
That's Anyways, more entertaining to watch.
What do we got? What are you going to want to talk about?
So let's talk some charts. First of all, look how fast volatility came right back down to the bottom of its range on the VIX. I think it's so interesting to see whether or not the VIX can actually break to the mid to low teens here.
No, it's not. It's going there.
You think so, right? Well, for sure. Listen, I'll tell you right now. If global equity all starts to rally and we have a push into the summer on the upside, you're going to be right. It is going to go down, and it's going to be a tailwind for the market, right?
Yeah, listen. All you guys are always looking for VIX.
You guys, it's all you guys.
It's all you guys. No, but you're often it's something that people love talking about in terms of this is volatility. I'm going to buy it and things like that. There's so much money lost. People trying to bottom tick volatility. It's usually a waste of time, and it usually costs you money.
Yeah.
And when you're sitting there, I'm looking at it. The realized volatility, by the way, is 13.5.
Yeah.
So even at 19,
but when you're talking realized,
17,
are you doing 10-day or are you doing 30-day there?
I did 30-day. I just pulled it up, but
what's the 10-day at?
I don't know. I don't want to go figure it out. But the reality is that it's getting quieter and quieter, and it's summer.
Yeah. And that's the thing, is that if the market doesn't get spooked in May, then things get quiet in the summer. That's definitely a possibility. So what I wanted to, though, touch on is look at that U.S. dollar against the Japanese yen. And it's been a theme with my members for a while that, this is the one currency that where the U.S. dollar can almost march the beat of its own drum. And it really has almost turned back up, and it looks like it wants to head to 111. And so you have this scenario where the U.S. dollar is breaking down against the renminbi. We were near 123 on the euro. All of there's just U.S. dollar weakness across the board, and the U.S. dollar just seems to be wanting to break out against the Japanese yen. It's really interesting to see that this is developing this way. You have any observations?
No, but it's actually a great point. The one thing I would say is that generally, Japanese, weakness accompanies risk-on behavior, and that's often what you see. So maybe it's just a function of that going on and on. I'm not sure.
I don't know if I'm super bullish on it, but could we see 111, 112 on the upside while the U.S. dollar weakens against other pairs? Maybe.
Yeah, I do think it's an interesting thing to bring up, though. It as you say, it is marching to its own beat of its own drum.
Yeah. And now let's talk about the asset that shall not be named. But
again,
but look at Bitcoin getting slammed again. And you know what? Whenever there's a sell-off like that, the actual down sequence is never what really is the big tell. It's about whether the bulls show up to do a rebound and the magnitude or the strength they have on buying the dip. And what we've really seen is that the wind has been taken out of the sails of the bulls, and they can't seem to put together a sequence of bullish days on the upside that really kind of turns the tide back to the upside. This is very distributive price action, and technically it doesn't look good. I mean, a break here could send Bitcoin under 30,000.
So, yeah, have fun staying poor, Patrick.
I'm not sure.
I can't believe you're saying that this doesn't look good. They're just don't you know, Elon and everyone, they're setting you up. They want you to think it doesn't look good.
You sound like a triggered man.
Yeah,
you sound like
no. Honestly, they want you to believe this because they're really trying to scoop all your Bitcoin from you at good prices.
There you go. All right, let's go on to crude oil, which is toying with breaking out to 52-week highs. Right? Just little prairie dogs. You're just poking up, but it hasn't really regressed. Is this finally going to get some tailwind and break out to 70 plus on the upside? I think so.
So people, if you ever have any doubt if Patrick reads my letter.
Why did you?
Yeah, there we go again. He misses it. Yeah, no, it's. I've made it my number one position, so it's never going to work.
Oh, you're kidding me.
No. It's okay.
God.
That's fine.
I'll make time to read your letter at some point.
To be fair, Patrick is traveling. He's in New York City, so he does read them occasionally.
Occasionally, especially the ones you tell me or have good pictures in.
Yeah, that's right. No, but Patrick, in all seriousness, there was lots of developments on the energy front. The IEA came up with something. They basically outlawed any sorts of new projects after 2021. We had a big court case where, in essence, I can't remember who it was. One of the big oil majors got held in contempt for responsible for global warming. The reality is we're not going to have any new supply. And when you get a situation where we don't have any new supply and then we have the same demand, And in fact, you might argue we're going to have increasing demand because of China growing. It's going to result in higher prices.
Why are you bringing fundamentals into a talking chart session?
Oh, I'm sorry.
Sorry,
Jesus,
that's
like
right.
It's looking good. Okay, but anyways, the little squiggly line's looking good. You should own it.
All right, so let's talk. One of the really interesting things for me when looking at a lot of the commodity markets is that they all went through a correction. This is copper, but we see this in the grains. We see this in a lot of the other markets. They all pulled back ever since that CPI number. They all like that super hot CPI print marked a swing high, and they all pulled back. But in the last 24 to 48 hours, all of them upticked and tried to turn up. Now, that doesn't get me excited in just one breakout candle, but we have to pay attention because it'll be really interesting to see. A lot of times these develop as flags and wedges that are midpoints for continuation patterns to the upside. And while I was cautious about whether or not this entire commodity reflation trade has run a little too hot, if these things can actually follow through on this breakout, we might have another full leg higher here, and we'll see. Anyway, the bottom line, we got a little breakout candle. I think it's really important to watch into next week whether that all follows through on many of these commodities that have turned up this way.
I'm bullish. I got to own them. I think they're headed higher.
All right. The last thing I wanted to touch on is let's look at the 10-year bond. So this is the bond futures, not the yields. And they have been basing, and you have not seen the bond market. It looks like that all the inflation fears were priced in that original bond collapse that happened at the first quarter of the year. And all these kind of things that have been coming out as headlines, it has simply not moved the bond market. And it continues to look like a solid basing formation. The question I have here, can we see another leg higher in oil and all these other things and the bond market not react to it? Every bone in my macro body says that we should go back and double bottom retest, see yields once again, like go 175 or something like that. But boy, the bond market doesn't seem to be interested in pricing anything like that in right now anyway.
That's a great question, though. Could oil rally $10 and bonds not go down? Of course, never. But what are the odds? And
well, that's the interesting part, right? Because this almost looks like it's rolling up, like it wants to go higher, but crude oil is punching to 52-week highs. Like something's got to give, in my opinion.
I'm not sure if I agree with that completely. You could have a situation where the bond market ignores commodities for 3 months, 6 months.
Yeah, okay, there could be a lag. Yeah. But inevitably it'll still care. But then
it'll
all care all at once.
There's still a lot of people that believe it's transitory. And I noticed that there's more and more of the talk about how this is going to be a temporary phenomenon. And it used to be that those deflationists didn't get any sort of publicity over the last, the previous month. And now,
I won't lie, they're rubbing off on me, buddy.
Of course they are. Of course.
I'm a little bit of a deflationist at heart.
A little? Who do you think he was talking to about with the Lacey Hunt posters? You love these guys. They're so smart. Okay.
All right. Anyway, so that's it for the charts. All right, let's go on.
All right, Patrick, it's time for This Week in Trading History. What do you have planned for us?
Oh, well, I think we need to talk a little bit of Salomon Brothers, a little bit of Liar's Poker. And so I wanted to go back to May 23rd of 1991 when Salomon Brothers got caught in the Treasury bond scandal. And so in the beginning of the 1990s, saw what was one of the great scandals that nearly brought Salomon Brothers down. So the Treasury rules for auctions in the U.S. For U.S. issues of notes and bonds stipulated that no one purchaser could bid for more than 35% of an entire auction offering. Solomon, however, could and often did bid for itself up to that 35%, and as a broker for one or more of the clients, up to 35% for each of those clients. So Solomon circumvented these rules, and it was in May in 1991, during the auction of this 2-year Treasury note, that they submitted these false bids in the names of 2 of its clients, in addition to the 35% they did in its own name. When these submissions won the auction, Solomon then entered into the computer the fake sales into its clients' accounts. As a result, Solomon controlled 10.6 billion of the total of the 11.3 billion auction, putting in a very strong position to squeeze dealers who had taken positions in the when issued market for the May auction. So Solomon could consequently charge higher than expected prices to these dealers and make huge profits off of it. So this became a nightmare on Wall Street, literally, when this happened. And so in part because one of the Solomon clients, whose name was used to actually win the auction, actually made their own legitimate bid. It raised their total amount over 35%, and it initiated an investigation, and that's how they got caught. And so after the probe uncovered in detail what happened in May, they found previous instances of similar false bids and discovered that the top officials at Solomon, including a good friend, had been told of this on one or more occasions and did nothing about it. And so that's when famed investor Warren Buffett stepped in, who was Solomon's largest shareholder with $700 million stake at the time, and actually took over as Solomon CEO and chairman away from good friend, who resigned. So did Tom Strauss and also John Merriweather, who was the vice president and supervisor of all the Solomon proprietary bond trading. And so at the same time, Paul Moser, who was head of the government bond trading desk that made the false bids, got fired. Had Buffett not stepped in to take over, observers speculated Solomon would have gone under. And in the end, it was a very rare thing on Wall Street, but Paul Moser's got actually sentenced to 4 months in prison for lying to regulators and making these false bids. And the firm ended up paying $290 million in fines to the SEC. So that happened this week in trading history, Kev.
Do you know a lot of people that haven't been around during that period, don't really remember it, but Salomon Brothers was the go-to house when it came to fixed income. They were the Goldman Sachs that could do no wrong. Everyone wanted to be Salomon Brothers. If you go look, John Merriweather, who ended up leading long-term capital, he was on that desk, and that's the famed liar poker when him and John Goodfriend had their kind of their big $10 million no tears episode. And I think that this is a great reminder of how quickly, you can sully a reputation. This firm went from being the absolute just top of the pinnacle to their kind of day-to-day existence being questioned. And you're absolutely right that Buffett came in, he cleaned house. The thing about Buffett coming in is that he always hated proprietary trading. So he just immediately took a hatchet to all the good departments. He even the people that weren't involved in this, and like John Merriweather, he really wasn't part of that. He was on the proprietary group, and this was definitely the client group that had done that. And yet John Merriweather was tainted with it, and ultimately was the reason that he went off on his own to long-term capital. So from there, many different things happened, and who knows, had Moser not done that, the world might have been a much different place.
That's for sure. All right, let's move on.
Okay, it's time for Skin in the Game. And I guess I won one.
You were right. I was wrong. It happens once in a while.
I get lucky.
You get lucky. All right. So anyway, let's quickly go through what the bet was. I thought volatility was going to come in, and in either direction. Like we were saying, we just said that the range higher and lower for the week would be greater than, or it was 3%, and your choice you had was whether you thought it was going to be below or above 3%. You took under, and you won. I was comfortable taking the over, and I was clearly too comfortable in making the overbet. And what did you get, a burger out of it?
Yes, burger, and I'm looking forward to my burger. So listen, let me tell everyone about the game. Skin in the Game is our weekly opportunity for us to demonstrate that we are degenerate gamblers at heart. Every week, one of us presents a wager, and the other guy chooses which side of the bet he wants. Every wager needs to settle by the next episode, and the currency for the wagers is as follows. A Duke and Duke, which is a crisp $1 American bill, which we haven't booked in a long time, right? Like we haven't done that one in ages because we're just.
It's the lowest one. It's basically us admitting that neither of us have any conviction.
Wants to trade. Yeah, pint of beer, a burger bet, a pitcher, a case of beer 2-4, a bottle of wine with $100 limit, and then the big daddy, the steak dinner. The winner of the
that's not the big daddy.
Oh yeah, the chinchillas or whatever. That's not going to happen, and nobody wants it to happen. That's the important part. The winner of the bet is obligated to create a new bet for the following week. All wagers settle in full, and there will be no netting of positions. So now I guess it's up to me, right? I have to come up with a bet.
That's right.
And so,
are you literally just making it up right now?
Of course, you know that. It's like most of the show. So VIX, I got to do VIX.
Okay.
You know, and I'm trying to think of something to spice it up a little bit and not just do this. So what
are we using just a VIX index right here? That's on Trading View?
Yeah. So what I've decided is I'm going to do the average of the 5 closes of next week. Oh, no, it's not 5. It's 4.
Yeah. Because
So I'm going to do the average of the 4 closes of next week. The average. Is it higher than lower than the current close?
I'm going to say higher.
Of course you are. Great. Okay, good. We got it. So the average of the 4 closes, Tuesday, Wednesday,
so just
Thursday,
to be clear,
Friday.
the VIX on TradingView is closed at 16.76.
Yeah, we're going to use that. Okay.
We're going to use that as the number and the average. And it's not that I don't actually believe that the VIX can go lower, but after having this kind of a move, I just think that the average of the week could be at this level or higher.
Yeah, no.
It might be 17. I'm not talking about it going to 22. You just gave me an over-under, and I think over is a good bet.
You don't need to justify it. Don't
okay, I'm just saying I took over. All right, done.
So what do you want to do?
That's look, you know what? Let's do a pitcher.
You're done. Pitcher it is.
I'm done.
Pitcher it is.
Taken. All right, sounds good.
Okay.
All right, Kev, it's time for No Stupid Questions. Lena, hop on.
Hello.
Hey. So there's no stupid questions, only stupid answers. So let's start off and see what happens.
All right. So first question. Once again, reminiscences of a stock operator got me questioning my trading. Gun to my head, the trades I've on that I truly believe in are miners, uranium, copper, oil, coal, and shippers. Yet I've got around 20 trades on. The other 14 trades are just BS trades that other people like and insurance type trades to protect a portfolio. The speculator is not an investor. Edwin Lefebvre. I'm not a portfolio manager. I'm a trader. Am I right to think I should cut the trades I don't love? Use my excess margin to go hard on these 6 trades I do love, but with some protections so my downside risk is only 2 to 5% for each trade?
So that's a great question.
Yeah.
And Patrick, this this listener is quoting your favorite book.
Absolutely.
Something that you quote all the time. Did you want to take the first shot at it, or do you want me to?
Well, this is the thing, is that portfolio theory is about how to construct a portfolio where diversification is the risk management tool. But a trader or a speculator is managing risk through actively managing the trade as opposed to diversifying. It's 2 different approaches. It doesn't make one right or wrong, but in the end, if one is considered a trader or speculator, then you're going to take your positions harder and take more risk in trying to make a bigger return. That's my view on it.
Yeah, well, the other thing that I noticed is that his 6 that he loves, miners, uranium, copper, oil, coal, and shippers,
are pretty much all reflation trades that are all along the same cyclicals.
And one of the worries that I have is there's nothing wrong with concentrating your bets and doing it. There's some very famous investors that have always said that, put your eggs in choose a few eggs and watch them very carefully. I can't remember who said that, but I'm sure everyone's going to tweet it to me afterwards. But it was either Jimmy Rogers or Druckenmiller, one of those fellows. The thing that I'm thinking about is that I worry about it is if it's all the same trade, then you might think that you're protected. You know, you have 2 to 5 risk on each trade, but reality there's 6 trades, and they're all going to move together, and you could see a situation where very quickly you lose 30-40%. I have nothing wrong, no kind of fundamental pushback against having less trades, and there's no doubt that there is an optimum amount for a trader. You know, at a certain point, you can't watch that many trades, and you just don't have that many good ideas. There's just no way. So where that line is probably different for each person, and how their style is, what their time frame is. And I think it's a little bit of getting to kind of know, what your style is. The one thing is that if you're just watching these other trades and they're quote unquote BS trades, then you probably should get rid of them. Now, that doesn't mean you should then go double up all your existing trades. Maybe you should just get rid of them and you should just focus on your 6 with the exact same risk parameters and nothing else changes. I definitely think that that's another thing to think about when you're trying to kind of put all this in your mind. And Patrick is bang on correct when he says that there is a big difference between a trader and a portfolio kind of constructor. Making something for your retirement account that you're going to hold for a couple of years is much different than somebody that's actively sitting in front of the quote machine and putting on trades that they're managing very actively.
Right.
Second question?
Yes.
All right. Hi, I've recently read Kevin's old article on how to be long inflation break-evens. So now I have a question. What tickers would you recommend to follow inflation break-evens on Europe and Japan? Also, since most of the talk is centered about America, I have no idea how American debts are going to affect me. I live in Europe. Love your show and all that stuff.
So I have noticed that I have these old articles on Medium, and they sat there a couple of years ago with nobody watching them, Patrick, like 0. I get like a little thing like 2 people saw your article. And then recently, with inflation taking off and everyone loving this trade, I've noticed that a lot of people have stumbled upon it, and I get these emails that, X number of hundreds of people have read it. So the question is, how do you follow inflation break-evens outside of the U.S.? And there is no doubt that, the U.S. being the largest instrument, largest country in the world with the most, liquid kind of and most actively traded financial markets in the world, it's much easier to follow those in the U.S. Having said that, a lot of the same kind of over-the-counter swaps and things like that I talk about in terms of break-evens and inflation swaps, they all exist for the European and Japanese market. Like, I'm just pulling it up here, Patrick. I've written extensively recently about the U.S. inflation swap curve, and so I decided to pull it up and see what it looks like in Europe. And can you guess what the 10-year index or the inflation index swap curve is, or swap tenor is for in Europe?
I haven't looked, so I would.
Yeah, but just like so in the U.S. it's 2 with something. It's like 2 1/4 or something.
Is it negative or near 0?
Yeah, it's negative. It's negative 1.4. It's mind-boggling. So there are, to answer this listener's question, there are all sorts of instruments out there that you can go look. Unfortunately, you're going to need a Bloomberg or Reuters terminal or something of that nature, because there is very few kind of, let's just say, active instruments otherwise that you can trade. But they do exist, and you can also just go and try to figure out the way. If you want to find break-evens on your own, you could go find out like a TIPS yield, a European TIPS equivalent, meaning an inflation-protected security. Figure it out for a certain tenor, like pick a 10-year, and it'll have a certain yield, and then go figure out the nominal, and you can create your own break-evens, and that's another way to do it.
Right.
Next question, Lena.
Hi, I love the podcast and thanks for taking questions. My question or questions are unfortunately a bit vague, but I'm just generally wondering how trading of the dollar index, Dixie, works given it is formed of 6 components that can be traded individually. For example, is Is the majority of US dollar trading done in Dixie contracts that then affect movements in the constituent markets like the Euro CAD, or does trading in the individual components far outweigh trading in Dixie contract? If most trading is done in the individual components, does it make sense to perform technical analysis on the Dixie rather than those said components? Are there sometimes situations when analysis of the individual components points to a different conclusion than analysis of the overall Dixie? Thanks for any thoughts that you can offer.
All right. Well, Kev, I'll just start, and then you can kind of add to it there. But the one thing that the dollar index is, it's just an index. Like, it's no different than the S&P 500 represents an index of the 500 largest companies in the United States. This is meant to be an index showing what the U.S. dollar is doing relative to a basket of currencies and it trade weights. It means that the Dixie is predominantly weighted to the euro, I think well over 50%, which really makes it very much anchored off of what the euro USD is doing. But really, in the bigger picture, it's just a way of gauging at what's the general trend of the U.S. dollar. There's always going to be components or major crosses within there that are going to diverge or march to the beat of their own drum. But that's what makes an index, is that it's the average of it to kind of give you a gauge of what the overall trend of the currency is, right?
Yeah, so I went and looked at the history of this index, and since it was created, there's only been one altering of the basket, and that is when the euro was created, and they kind of amalgamated a bunch of them into that European US EUR kind of currency, and that's part of the reason that it's such a high weighting, is because previously it had been the West German mark, the French franc, the Italian lira, the Dutch guilder, and the Belgian franc, and then the euro replaced those five. Now, since then, it's basically, as you mentioned, it's the fact that the euro is a 57.6% weight, the Japanese yen is a 13.6%, pound is 11.9%, the Canadian dollar is 9.1%, Swedish krona 4.2%, and the Swiss franc 3.6%. So there's no doubt that it ends up being very much centered against the euro. You say it's trade weighted. I actually don't. Are you sure? Are you sure about that?
That's what I was under that impression. I might be wrong.
I don't think it is, because there's actually a trade weighted index, and not only that, if it was trade weighted, then you would have to be altering it based upon as trade has changed over years.
Right.
So it is not. In terms of the technical analysis mumbo jumbo, I don't practice that dark art.
First of all, the key is to look at the overall trend of the dollar as a market. The overall trading of the Dixie will not move the individual components. The individual forex crosses are just so huge in their volumes that the dollar index is just a smaller component of that, right? I mean,
you're not going to move it. It's just a reflection. Yeah. I like trading it, though. I think it's a great little tool. Yeah. It would be nice if the euro was a little smaller and you had maybe a few other ones in there. But I think it makes all sorts of sense to be to trade it, and just to there. I don't think there's anything wrong with performing technical analysis on it, since it's all magic anyways.
All right, let's go to the next question.
Right, the last question.
Even Lena's having trouble with my making fun of technical analysis. She doesn't even know. She's like, oh, God, Kev with this. Okay. Anyways, go on. Sorry.
I've recently come across some companies raising capital through secondary offerings and using the proceeds for buying non-trivial amounts of a specific commodity to hold on their balance sheet. Obviously, the commodity has very different volatility characteristics than the equity, but the option chains didn't respond to the change. The option writers didn't seem to care. What do you think might be a good way to take advantage of this probable mispriced equity vol due to expanded balance sheet vol? Is there some combination of commodity options and equity options that might offer arbitrage which the option market makers aren't accounting for? A fictional example might be if Newmont raised cash to buy a bunch of gold that expanded their balance sheet significantly.
So I'm going to jump in here because I think this is a terrific question. And what it comes down to is that the companies are changing what should be their expected volatility of their stock price by making it more levered and by introducing ownership in a commodity, which I'm assuming might have more volatility than the underlying actual business. And that's, I guess, what you need to be careful of. You got to make sure that you're reading that correctly, because oftentimes individual companies might be higher volatility than their underlying, company many times companies will have a higher volatility than the underlying commodity that it's,
That's more common.
Producing. But that's more common. But I just kind of wanted to talk about this because this listener was kind of confused because he or she was looking at this and not realizing or wondering why the market wasn't adapting. And sometimes markets aren't as efficient as we all think they are. And there's all sorts of professional traders out there that are looking for changes in the nature of a company or of a commodity that haven't been reflected correctly in the options market. So when you see this and nothing changes and you're kind of thinking that you missed something, it might not be that you missed something. There's all sorts of examples of, professional traders that I talk to that'll sit there and they'll say, look at this, the market hasn't realized that the annual meeting is in this month instead of this month, and therefore they're not, pricing this volatility correct versus the other. And they will go and, put on trades that are kind of complicated, sophisticated trades to kind of take advantage of that mispricing. And now, as for this, my initial reaction would be to say, if you have a company that's increasing their kind of riskiness of their of the underlying kind of security or of their share price by levering it up to do the commodity, one thing you might want to do is you go long that stock in terms of not long in terms of actual delta long, but long in terms of volatility long. And then you could be short volatility against another kind of company in the same sector. Now, obviously, you're still going to have risk in terms of that sector might, that other company might have something you didn't anticipate. Or you could even go and let's just say in this case, you think that Newmont is making their balance sheet much more risky. So you go long vol on Newmont and you go short vol on GDX. And then what you do is you delta hedge them both, and then hopefully at the end, whenever your time period is over, you'll have experienced an increased volatility in the actual Newmont versus GDX, and it'll be a profitable trade. Or the market will realize that, and then you can trade out of it.
Right.
Anyways.
Makes
Lena,
sense.
Is that it, or do we have another one?
I believe that's it for this week.
Okay.
So where can they submit their questions then, Lena?
So if you have any questions for Kevin and Patrick, please submit your questions to nostupidquestions@markethuddle.com.
Thanks for tuning into the Market Huddle. We appreciate you spending time with us. Please give us a follow on Twitter @the Market Huddle. We're there every day. Lena does a great job. She gets tired of talking to Patrick and I and loves chatting with you fellas. Although they're mostly fellas, let's face it. But if there are some ladies listening, make sure you reach out to Lena because she'd probably like to know that she's not alone having to listen to us. You can listen to the Market Huddle on all the networks: Google Podcast, Podbean, Spotify, Android Play, iTunes, and YouTube. A lot of people watch on YouTube to see all of our charts and visuals. And while you're there, please like and subscribe to get our latest content. And please, I'm not going to say this. I usually ask you to rate or review us on iTunes. We're not going to do that. I'm going to read you a couple, and I've chosen these. So first of all, Fort Bacon. Anyone?
What a great name.
Exactly, Fort Bacon. That guy's awesome. It might be a woman, but let's face it, it's probably a guy. I have a brother-in-law that has the Bacon Eaters Club, and he does a weekend, it's not Canada Day, it's the Labor Day weekend. They go camping, and they eat nothing but bacon for 3 days.
Wow.
Yeah, that's commitment, eh?
My arteries.
Nothing but bacon. You're not allowed like bread. You're not allowed anything else. You're allowed condiments on your bacon, but you're only bacon. It's awesome. He's never invited me though. Okay, so listen to Fort Bacon. Maybe this is him. Important part. These guys are smart. This guy's obviously not listening. Have years of industry knowledge. Get enlightening guests that he is correct about, and ask great questions some of the time. More important, they are funny and they talk about obscure brews. So this guy's getting right to the point. They get funnier as they get into the show, obviously the brews, and they are Canadian, which adds even more flair. Like, what are we, like some sort of exotic animal? Like it sounds like they've been inside just a little too long this winter. Now, I 100% agree with that portion of it.
Yes.
We always feel that way as the winter goes through. This winter is especially bad. I was chatting with one of my good pals that I've come to know on, we trade together, and he's on Cape Cod, and I told him today that it was snowing, and he literally sent me, a whole paragraph of bah-ha-has. Like, it was... Okay, second review.
Okay.
This is from mchambo72. These two are fun to listen to. They have great guests and insightful market insight in their own right. The beer of the week just puts it over the top. A big thank you to Patrick and Kevin for keeping it real and fun. By the way, if you run into another week without a beer sponsor, okay, we have lots of weeks without beer sponsor. Hit me up on Twitter, and I'll give you a fun beer to try and rip for an entire episode.
Nice.
Now, this has got to be a millennial, because what do you rip a beer? What does that mean?
Oh,
I mean,
God. Don't
a Gen
date
Xer like
yourself
you wouldn't
without
know.
saying
Exactly.
how old you are.
I always get
I
always get
don't
in
know
trouble
either.
for that. And by the way, I'm a boomer, according to most people.
What?
No, that's what they purposely love to call Gen Xers boomers. It makes us mad.
I'm triggered. I'm triggered.
It triggers us. They try to trigger us, but the reality is that we're Gen Xers and we just don't care.
We're too drunk.
No,
to
we
care.
just don't care. Like, that's the thing. We're like, we just don't care. Anyways, Patrick, where can they find you?
You can find me on Twitter at Patrick Ceresna, and you can follow me at bigpicturetrading.com. Kev, where can they follow an amazing newsletter that I sometimes read?
I'm on Twitter at Kevin Muir, or you can check out my newsletter at themacrotourist.com. And listen, we can never have too many friends. Bear market, bull market, we're just happy to spend some time together on this crazy ride. So thanks for tuning in. Now stick around for the after show. Okay, let's do the beers quickly.
Yeah.
Patrick is actually in New York, and he's got some events to attend.
Yeah.
So we have to cut that. We have to do a rather quick,
Efficient.
We're gonna
efficient.
keep this tight.
So let's quickly do the beer. This is way better than PBR, like just way better. And like, what did I give PBR? Does anyone remember?
Like a 5.2 or something.
Okay,
You didn't like it.
this isn't good though. Like, it's not good, but it's way better. So my only criteria is I got to be above PBR. So if I gave PBR like a 5.2, which sounds about right, I'm giving this like a 6.2.
Okay.
Lena?
I would give this a 7.8.
Wow,
You're
so
finished.
you rated it. You gave PBR an 8 something.
I mean, PBR's got a
So you guys
a
are on
soft
the
spot for
Yeah,
PBR.
listen,
Right.
PBR is terrible. This is better than PBR. And I don't know if I've committed some sort of like hipster faux pas by saying that.
Both
The thing is,
beers.
they're both brewed by Pabst in the States.
Oh, really?
It's only in Canada that
So,
Old
you know-
Milwaukee's brewed by Sleeman.
You know what's going to be
So,
funny? What if it's the same beer? I'm giving different ratings.
Yeah, that's probably what it is. They just changed the label and put the same beer in the can. What I was about to say, it's the same thing for me. Like if I was at a baseball game eating peanuts and stuff like that, and sitting there and I got to chug like 5, 6, 7 of these and they're ice cold, that's perfect. But for me, like, this is such an ordinary beer. I'm gonna give it. I'm gonna give it an amateur score again. 2 weeks in a row, 6.0.
There we go.
Boring.
Exactly. I'm gonna give it a 6.0 just because it deserves an amateur score.
It's not that bad, though. The PBR was terrible. This is way better. Listen, let's talk quickly shows because Patrick's got to go. But Lena.
Oh, but by the way,
Yeah?
before you do that, just any of our listeners that made it this far, I'm in Manhattan all week. And we're thinking of doing a mini little Huddle Muddle meetup. Hit me up on Twitter, and I'll give you the details of where we're meeting up on the Thursday night in downtown Manhattan.
Tell people where they can follow you on Twitter, Patrick, one more time.
At Patrick Ceresna.
How do you spell
With
that?
one A at the
How do you spell
No.
that crazy last name?
Ceresna, but it's on the Market Huddle. You can just go.
There's a few tweets regarding this imposter.
Oh, the imposter. How many people are complimenting me that I made it? And I have an imposter.
Yeah, I've
but
never had
this
one.
Is,
and I
no,
I really don't
this is
want
my
one,
second
but-
one.
Oh, yeah,
but
I
this
know.
is my second one.
You're way ahead of me.
But
Yeah.
if you look at the account, all the tweets are in Portuguese.
The Portuguese imposter.
And then somebody tweeted saying fake Patrick is selling cable TV in Brazilian market.
Look, that's a hot. That's a hot market.
And then there's another tweet here. I assume the one with an extra A was the crazy Market Huddle Patrick on Friday, and the correct spelling was the sober Macro Voices Patrick on Thursday. I'll try to get the $10,000 I gave him for Guru services back.
Are we sure? Are we sure that the second one is imposter? Is things like maybe Patrick's just trying to huck some TVs in Brazil?
Side hustle?
And that's, you know what?
There's another one here. Is
I can't
Kevin
believe you
Muir
figured
using
me out.
this to get a Macro Voices?
Okay, let's
right.
just talk quickly shows,
right.
Lena. Did you watch, and this is completely up your alley, The Sons of Sam?
Oh, yes.
Okay. Did you maybe even talk about it before and I've forgotten?
I might have.
Okay.
But,
so
yeah,
I have a
I
question
did
for you.
watch it.
What's the guy who does the Paul Giamatti does the voiceover?
Yeah.
Were you able to stay awake with him giving you his soft, sultry, like?
Well, I knew. I was like, this voice sounds so familiar.
But it's like,
and I was like, who is it? Who is it? And then I was like, sounds so familiar. And then I had just watched another movie that had Paul Giamatti in it. So I was like, oh, it must be him. And
my
it turned
wife
out it
and
was
I
him.
are like laughing ourselves silly because like she rarely falls asleep watching things. I fall asleep all the time, but we both fall asleep on this one, and we've come to the conclusion that it's just he's so soothing. Like it literally, we have not been able to make an episode without not falling asleep. And you might think that means it's bad, but it's not. It's actually
It's
quite.
not bad.
It's quite
It's
good.
great.
And
Yeah,
listen,
it's
for
good.
anyone that's interested, it's The Sons of Sam: A Descent into Darkness. And one of the reasons that I particularly loved it is it was a lot of it was about, especially the first couple episodes, was about New York City in the 70s. And not having grown up there or not being going there and things like that. It's hard to realize how bad it was. Like it was like,
It's scary.
Oh, and it's kind of shocking how much that city has turned around. So I think it's fascinating from that perspective alone. Like I would like to go and take the spots that they have videos of, like, this spot, and go see what it's like today.
Sons of Sam tours.
The Sons of Sam tour, yeah.
Well, the funny part, I was listening to that, the podcast that Mrs. Macro Tourist likes to listen to.
Oh,
My
the
Favorite
ladies?
Murder. Yeah, so I'm trying to catch up to their episodes, and they had just done that episode, the one that I was listening to. So to see that on TV after, I was like, oh my gosh, I'm so stoked to watch this. And Luke is like, I am so convinced you're going to murder me later.
Yeah, women's obsession with the murders is kind of strange. Like, it's weird. I do remember, though, I had a buddy. I can't remember if we had him on the show. But anyways, I had a buddy that grew up in Brooklyn. And I was asking him about it. And he's slightly younger than me, maybe 10 years. So he's probably 40. No, he might even be 15 years younger than me. And I remember him telling me that he said when he grew up, is it Washington Heights that everyone wants to live in? I think it's Washington Heights that everyone, like, that's the Tony, like, fancy neighborhood, because I think it's close to the city. I remember him saying that, like, my parents wouldn't let me, like, slow down in the car if I was driving through there. That areas that we've kind of assumed are these fancy, awesome places in Brooklyn were scary as AF. Like, just unbelievable. And so I don't know. I just find that actually fascinating that a city can turn around that quickly and change.
Do we have areas
You just
like
have to
that
have
in
a
Toronto?
robust prison system so you can just throw everyone in it.
There we go. My right-wing friend over there.
Do we have places like that in Toronto?
No,
where
we
it
don't.
used to
Listen,
be,
you know,
bad, and then now it's
I have like
great, or the
one of
other
my
way
good
around?
buddies that I was actually roommates with in way back when we were both young bucks on the trading desk. He's moved to Miami and he loves it, and he has great things to say about Miami. But I was asking him about Toronto, and I was saying, like, how do you what's the difference? And he says that, Miami's awesome, but there's sections that are just in another league. And I go, I picked a bad neighborhood of Toronto. I say, it's like worse than that. He goes, you can't, it's not even close. Like, it's not even close. And I think it just happens. It's just that, everything in America is bigger and kind of exaggerated compared to us. We're just boring. Like, so the reality is when they do everything, they do it big. That's just the way they are.
That's true. So true.
Anyways, fascinating show. Don't do it if you're about to go to sleep because you're going to, or use it as a sleep aid.
I didn't fall asleep watching, but Luke did fall asleep.
Yeah,
so
see?
yeah.
Yeah, there you go.
I don't fall asleep to murder stuff.
Anyways, great show, though. And it's really interesting. Sons of Sam. I have a question for you. Do you think he did it alone? What do you think?
Oh, I don't know. It's like, when they presented it first, they were like, oh, it must be the guy. And then, when they presented that theory of, oh, it could be, there will be accomplices or whatnot. It's like, oh, it makes sense that there would be accomplices and this may have been like an organized crime of sort, but who knows? It's all speculation, but it is fascinating.
It is a good show. It is quite interesting to watch.
Patrick has no idea what we're talking about.
No,
he doesn't.
No.
What are you watching these days, Patrick? Anything exciting?
No.
Patrick wants to go. He's got to go and.
He's looking at his charts. That's the most exciting thing.
How about you, Lena? Did you watch anything? And then.
You know what? I have been watching good old Forensic Files episodes from like 1992. So I'm literally into all kinds of murder stuff and crime, solving.
God,
desperation. I need
like,
more
are you going to
content.
try to become a detective?
Next thing we know, you're going to be watching That's Incredible.
What?
Patrick
Which
gets
was
it.
that?
Lena, you're too
I
young.
don't get it.
There was a show
I'm too
called
young
That's
for this.
Incredible. Forensic Files
have
from
to
the
look at it.
90s. Like, that's pretty bad.
It is bad. It is bad.
Oh,
doesn't fit on
it
our
went till
widescreen TV.
2011, though. It's not quite all.
But it's super dramatic. That it's like, oh, Susie and John were living in a perfect life in wherever California. But then and then and then they go into the whole thing.
It's always in California. It is. My wife was telling me that there was a time when there was like more serial killers in like this section of California than like it was like crazy amount of how many they figured there were, and it was because they couldn't find them, and there was a whole bunch of things, and it was like the golden age of serial killers.
Yeah,
and it's just like
I think it's like 1974.
Yeah, and it's
I
like
think they said
you
was
couldn't.
like,
Well, like you read about Ted Bundy, and like he literally would just kill people and then go to another state, and there would be no interstate stuff.
So crazy.
So you just be like, okay, I'll just, I'm done here. I'll go to the next one. And you're like, what? Like, and we take for granted that all of this thing was connected and that you wouldn't, you'd be able to figure this out, but you wouldn't. Anyways, it's
that's what I say. When it's warm all the time, then you bring the crazies out.
Yeah. Speaking of which, these bugs. Have you heard about these bugs? They've been sleeping for 17 years or whatever.
Oh yeah. Oh my God, what is it called?
What bugs are you talking about?
No, I know exactly what you're talking about.
It's like enchiladas, but it's not.
Enchiladas. Cicadas? Are you
Yeah,
talking
that's
about?
exactly.
Enchiladas.
I can't believe you said that. All right, but it worked. She figured it out.
She figured it out. It's like that. Yeah. So, anyways, these bugs have been like sleeping for 17 years, and they've come out, and it's just
This is the year they come out.
yeah, and it's just like crazy.
I think they have different cycles.
But why
there's different
17
times.
years?
I
Like,
don't
why
know.
not 15? Like, keep it
They're
a round
super
number.
loud. Every summer you hear them.
Yeah.
No,
Don't
but
you hear them every
they
summer?
come out.
Do we have
but
these
They come
things?
out.
Yeah.
Are you sure?
I'm
No, but
pretty
they
sure.
come out. But they come out in
snow
a
in
big
May
storm.
doesn't at the end or almost in
Well,
June.
no, I think they come out in like July, August more. I think it's like July and August.
No, but
I mean,
but
I
there's
don't know
this
for sure.
one big wave that comes
Yeah.
out like every 17 years, and like it's
Is
gonna.
this is it.
Th-
Like
this is the
2021
17th
the
year.
year.
Like this is. So we're gonna have this like.
Okay, so here we go. So you know how all these like new age folks always want us to eat bugs?
This is the year to harvest them.
Well, like that's basically, they
Have you ever eaten bugs?
no. Not
I
on
have.
purpose. Like
I have.
I have
where did you eat
mealworms
bugs?
and crickets and stuff like that.
I've
Patrick
eaten
ate them on
grasshoppers.
when he was the
was
squirrel
on
when the squirrel wasn't quite enough meat. He was like,
I had to add some protein.
"That's right."
But you know what? I went to like a science center up in like the Sudbury one.
I know that one.
Eh,
We take the kids
yeah.
there. We used to take the kids there
Yeah,
all the time. Science
and
North.
they-
It's awesome.
Yeah, and they had
and they had bugs for you to eat.
They had they had them like roasted, and so you can try them out.
Oh, I miss that. Science North, great place. We used to drive up there all the time. For people that are interested, Sudbury, Google it. See how far north it is. It's far.
It's nuts.
So, anyways,
It's
listen.
nuts.
Back to the enchiladas. They taste a little bit like tinned asparagus, supposedly. Here, I'm reading a quote. It
So
says,
it's not that great. Then.
so those who have tried Kritsky included, because they are sucking on fluid from a root, they're going to have a very green flavor.
Oh.
But why is that bad?
He first ate them out of curiosity, much like Patrick, but stopped after his first Brute X encounter in 1987. So this guy was eating them for a long time. And he's like 87. That's like it. I really like these.
2 cycles ago.
They got me tenure.
Like, how did he eat them though? Like raw? Or
I don't know,
like
but I did
toasted,
notice
or
that
what?
some people are there's some hipsters in Brooklyn, that part where you weren't supposed to slow down. And they've covered them in chocolate, and they're making them. You can buy them.
You can get cicadas. Is that what they're
Yeah.
called? Cicadas.
Yeah.
Covered in chocolate.
Oh my
God.
goodness! There's an STD that makes them sex mad, but then their genitals fall off. Oh my goodness!
What are we talking about?
What are you,
I'm
you
reading.
talking
I'm
for
reading,
the bugs
I'm
or
reading
your
this thing about it.
your
There's some sort of
genitals?
fungus that's like, and it affects only males, of course. It causes the bug's abdomen and genitalia to fall off, leaving a mass of fungal matter. Oh, that does not sound good. It also makes him.
And then you're gonna cover that in chocolate.
It also
and
makes
eat
him,
it.
quote unquote, extremely sex driven.
So it's an aphrodisiac. Or
Oh,
what?
but not to mate, because he's been castrated, but to spread the fungus. It like sounds like something out of Game of Thrones.
Spread the STD of the cicada.
Yeah, this is bad
What's
news.
going on? This is bad. This is bad.
Oh, and then the infected male will start clicking its wings like a female to attract partners. Oh my God, it's like the vampire. This thing's awful. Oh, and then listen, it gets worse. It gets worse. It's just when you thought it couldn't get worse, it gets worse. Fewer than 5% of enchiladas are reportedly infected, but it is not uncommon for people to eat them for amphetamine in the fungus, which, according to scientists, is a very bad idea.
So is it like hallucinogenic?
I have
or
no
what's-
idea. This is just bad news. Maybe that's what they're selling in Brooklyn.
This is bad news
I'm just
all around.
hop skipping away. I can.
You
I
should
can
go check it out.
Yeah, go check it out.
I'm gonna go do
Investigate
boots
for
on the
us.
ground investigation.
Well,
Maybe I'll be the next one in one
Oh,
of the
Patrick,
murder
I-
videos that Lena
I
watches.
forgot. You know what? I got a place for you to go. I'm going to tell you this. New York, Madison Square Park. I got. I love tacos.
Oh, really?
Yeah, I'm actually a huge fan. Even though it's kind of like.
I was
Everybody
I
write
was
it
sure it
down.
was
Kevin
burgers
loves
and
tacos.
pizza.
No,
but
I
okay.
actually love. I love. Anyway, so I'm gonna get Madison
I
Square
love 'em.
Park.
I love 'em a
Where's
lot.
Madison Square Park? There's a taco place. My wife always says taco. You're saying it like
Tacos.
taco.
Taco.
It's just north of Madison Square Park.
It's like scheme. It's like
And I'm
scheme.
sure the New Yorkers are gonna laugh at me and go, "God, you like that?" Mexico. I think this is where I went, and I loved it. It was basically my favorite place.
What did you have there? What kind
I
of
had them
taco
all.
did
I
you
went
have
to the
there?
bar. I was waiting. Okay, so I had met with a guy at Madison Square Park, and then I was starved, and I was drinking, and I just went there, and I sauntered up to the bar because it was basically packed, and I was all alone. I just sat down and I said, I love doing this. I say to them, bring me whatever you like. I literally I do discretionary orders.
Wow. You're brave.
Oh, well, listen.
That's the way.
That's the way to go. They
Yeah, I agree
know
with
better
that.
than you do what's good.
Yeah.
You know.
They know what's most expensive on the menu. That's
Yeah,
what they
maybe
know.
they're doing that, but the reality is that they also know what's good. Listen, I always
Or
do that.
popular.
I'm always I tell them if there's something I don't
You
like.
got to take yourself out of your comfort zone.
Yeah, you gotta try stuff.
You got to try.
You know what
new
happens
things.
to people that get themselves out of comfort zone? They get murdered. That's why they're watching all these shows, you know?
There's Lena in her safe space.
Anyways, go to this
Okay,
place, Patrick, and everyone's gonna laugh at me, but I love it. Mexico.
All right, Mexico.
And it's
I'm in.
you know where Madison Square Park is?
yeah.
Okay, so go.
there.
It's not Madison Square Gardens, which is much different than Madison Square Park. And by the way, Madison Square Park, I believe, is where the original Shake Shack was. So
Oh.
basically, I just go to.
I went last time I was here in Manhattan. I went. I'm not gonna do that again.
Basically, I just
I'm
go to
doing the
Madison Square
steakhouses.
Park all the time. Between Mexico and Shake Shack, I'm done. I don't need to go anywhere else. That's it for me.
Wow,
I'm
there
like,
you go. Report back next week, Patrick.
Here I am, like, gonna go do all the nice restaurants. What a fool.
yeah, you're a fool. You should be going to Shake Shack.
fool. What
You
a
can go to the
fool.
you can go to the original Shake Shack. And listen, Shake Shack is awesome. I don't care what anyone says. Shake Shack is awesome.
I agree.
You know,
I'm not gonna object. The burgers are good.
they listen. It's better than good. It's awesome. Americans don't understand how good they have it. They don't appreciate
don't
the
have
Shake
it here.
Shack. They really don't. And it's like one of those things, like, you know, like the great partner that you have, and then you think that you could do better, so you go get rid of them, and then next thing you know, you're like, oh, geez, that was the great partner. That's like Shake Shacking with Americans. They don't understand how good they have it.
Do you like Shake Shack or In-N-Out better?
Oh, Shake Shack by a mile. In-N-Out's good, and In-N-Out is better value. If you looked at like the cost.
Overall value.
Yeah, I don't know how they make it so cheap. It's scary cheap. Like, you're like,
But apparently they treat their employees really well. I don't know.
I don't know how they do it. Like, because like the reality is, like, I figured there's got to be somebody like working for pennies on the dollar somewhere, because like that's like the cheapest good burger that's out there.
Is there a Shake Shack in Miami?
Yeah, well, he's in New York. He can go to the original. Forget about Miami.
Well, no, I want to know.
For when you go. Yeah, you got to.
Yeah.
I'm sure there's
I
a
gotta
Shake
go.
Shack.
Oh no!
in
You know what?
Miami.
I'm saving it. I'm gonna do it with Lena.
Yeah, we're gonna go to Shake
We're
Shack.
going. We're gonna
I'm
Shake
sure
Shack.
there is. I'm pulling it up right now. Oh yeah, here we go. You got Miami Beach. You got a bunch of
Nice.
them.
Miami Beach right there. Perfect.
Yeah.
Perfect.
There it is.
There you go.
We're going to Shake Shack in Miami.
Boom.
Boom. There you go.
Boom.
Have one for
All
me,
right.
guys, because I love that place.
We'll
we're
have
gonna take a
two
picture.
for
We'll
you.
put it on Twitter for you.
For sure. Sounds good, kid. Now, Patrick's got to go, so we'll call it a
Yeah.
night. You know what?
All
One
right.
last time, let me just remind everyone, it'd be terrific if everybody went and actually did our little thing, our social science, I can't even say social science. Again, one last time, Cutley, CUTT.ly/Jim Leitner 2/3. If everyone could do it, we'd really appreciate it. I'd love to see if we, you know,
It's funny how you assume people are actually listening this far into the show.
We'll tweet it out.
yeah, there's some that
Go,
are
go.
listening. No, there's some. There's some.
There's definitely some.
Yeah.
Fools.
You know what usually it is? I think they've fallen asleep and then they wake up towards the end. That happens to me all the time.
I can't believe these guys are
like one
talking
of my
still.
favorite podcasts is this thing called No Agenda, and it's regularly 3 hours. And I fall asleep all the time and wake up and I'm like, oh shit, okay, I missed an hour of that. Let's just keep going. And that's what I figure the people will be like with us. And let's face it, most people just listen to the guest and hit stop.
Yeah.
Right.
If you've stuck around for this
Yeah.
long.
Anyways, and,
All right.
and so either you're a big fan or you've fallen asleep and forgotten to hit stop. Okay.
Yeah.
Anyways,
Yeah.
have a great week. Have a great time in New York, Patrick.
All right,
Enjoy
thanks.
yourself. Stay
All right.
safe, buddy.
All right. Cheers.
Okay, bye-bye.
Thanks, everyone.
Cheers.
All right. Bye-bye.